Hello candidates, and welcome to the learning platform. Today we continue with the subject Advanced Financial Management. The topic is merger and acquisitions. In our last session, we discussed the problem of valuation of mergers and acquisition. Today we move on to the valuation models. Valuation models. Now there are three basic approaches to valuation of mergers and acquisitions. The first basic approach or method is book value plus. Book value plus. Valuation models. The first basic one is book value plus model, which is also known as the asset-based model. Asset-based model. Asset-based models. Now the second valuation model is known as market-based models. Market-based models. Market-based models. Then we have the cash flow models. Cash flow models or cash-based models. So we have book value plus models, market-based models, and cash flow models or cash-based models. Now we will, in our today's lesson, be focusing on the first one. We're going to learn how to value mergers and acquisitions using the book value model or the asset-based models. So our focus is on the book value models, asset-based models. Now these models, candidates, we are referring to as book value plus models or the asset-based models, are models that we use in valuation of mergers and acquisitions, and the models here attempt to value the assets that are being acquired as a result of an acquisition. Valuing the assets that are being acquired. If a company is acquiring another one, company A is acquiring company B, then the assets of company B are valued. So the book value or asset-based methods of company valuation are based on the statement of financial position. Are based on the statement of financial position or the balance sheet. This kind of valuation is based on the balance sheet because that's where we get assets. A balance sheet is a statement that indicates the assets, liabilities, and capital of an organization. So the valuation of a target, the valuation of a target's assets is based on the statement of financial position. That's a very important point to note. And that is the starting point in the valuation process. So the book value or the asset-based methods of company valuation is based on the statement of financial position as the starting point in the valuation process. They use the statement of financial position as the starting point in the valuation process. So here, the valuer takes the value of the firm's assets, then deducts liabilities. And these values can be the book values, The valuation may be based on book values, the book values. This is using the values in the statement of financial position. Then the values that are used could also be the realizable values. Realizable values. Now the book values, we know these are book values that appear in the balance sheet, which could which are unlikely to represent the true value of the assets. They are unlikely to present the true value because these are historical figures. Then we deduct the accumulated depreciation and so on. But another value could be the realizable value. This means valuing the assets at a value at which they could be sold individually. So if you have motor vehicles, you look at the motor vehicles, what could be the realizable value? How much could the individual motor vehicles fetch? And this value is likely to be the absolute minimum that the sellers would accept, and therefore the absolute minimum worth offering, the absolute minimum, without adding any premium. That is what the sellers could accept, the amount of money that the asset could fetch, that the assets could fetch, that the asset could be sold. Another value could be what we call replacement values. Replacement. The replacement values. This is the cost of buying the asset individually. And this could perhaps be the maximum that the acquirer would be prepared to pay. Do you understand? Replacement values. The cost of buying the asset individually. Do you understand? Replacement. Now, that's all we can say briefly about the book values, book value plus or asset-based method. That's all we can say. So we've said here that the book values are based on the statement of financial position, and the values could either be the book values, the realizable values, the replacement values. Now I think we can now have an illustration from the KASNEB past papers. This is August 2023, question 4. I read, the statement of financial position of two companies, ARCO Limited and Bureau Limited, as at 31st December 2022 are shown below. So we have the ordinary share capital for the two companies, the preferred share capital, the share premium account. We have the profit and loss account balance, 10% debentures, non-current assets, and net current assets. The net current assets. So additional information number 1, ARCO Limited is proposing to acquire Bureau Limited by means of an issue of its own ordinary shares in exchange for the ordinary shares of Bureau Limited. Number 2, management of the two companies avail the following information to assist in the takeover. So we have the maintainable annual profits after tax attributable to equity holders. We have the current market price per ordinary share, the current earnings per share. Number 3, the corporation tax rate is 30%. Required, using earnings per share basis and market value basis, and assuming no synergy effects accrue from the takeover, determine the total number of shares the directors will have to offer to the shareholders of Bureau Limited. So here we are to calculate the number of shares to be issued to acquire the target. The number of shares to be issued to acquire the target. Illustration. Let me have it here. Grab this. I'm answering a question from August 2023, question 4. Here we are to calculate the total number of shares the directors of ACO Limited will have to offer to the shareholders of Bureau Limited. Now, ACO Limited is the acquirer, Bureau Limited is the target. So to calculate the number of shares to be issued to acquire the target, that is the question. Number of shares to acquire the target. That is the question. Number of shares to acquire the target. So what is the formula? What is the formula? What is the formula? The formula is we get the product of the exchange ratio and total shares of the target. The total shares of the target. The total shares of the target. The number of shares. Let me say number of shares of the target. That's how to calculate the number of shares to acquire the target. We get the exchange ratio. The exchange ratio. Then we multiply by the number of shares of the target. Look at the question again. Do we have the number of shares of the target? The number of shares of the target. The target, look at the information. We have ordinary share capital, par value 10 shillings. The par value is 10 shillings. Then the total amount of the target we can see is 5 million. But do we have the exchange ratio? No, we do not have the exchange ratio. How do we calculate the exchange ratio? We take the net assets or let me have just a working here. Let me have a working for exchange ratio. Exchange ratio, we know the formula is equal to the net assets of the target divided by the net assets of the predator. Net assets of the predator or the acquirer. That will give us the exchange ratio. So what is the value for the net assets? Net assets of the target. Look at the question. The net assets of the target. The net assets of the target. The net asset. What is the net assets of the target? Net assets of the target. The net assets of the target is 6.1 million. The net assets of the acquirer is 17.3 million. So 6.1 million divided by 17.3 million, that will give us the exchange ratio. Someone with a calculator? How much is it? Calculator. How much is it? Give me the calculator. The calculator. Let me my calculator. That will be 6.1 million divided by 17.3 million. 6.1 divide 17.3. So the exchange ratio is 6. Exchange ratio here is 6 point. Exchange ratio is, from my calculator, 6.352601. That is the exchange. So we take that ratio and come and plug in here. 0.352601. We multiply by the number of shares of the target. We take the total amount of the share capital of the target, which is 5 million. We divide by the par value of 10 shillings. This will give us the number of shares of the target. Then we multiply by the exchange ratio to get the number of shares to acquire the target. So I'm going to have 5 million divided by 10, that's just 500,000, times 0.352601. So the number of shares will be 176,301 shares. So the number of shares that the acquirer will offer the target company is 176,301 shares. Is that clear, candidates? So that is an illustration on the valuation of the target. In our next session, we are going to cover the other model, which is the market-based model. In our next session, we are going to do the market-based model. Thank you for attending the lesson. Bye-bye.